Advanced Charitable Planning for U.S. federal income tax purposes. Educational disclaimer. This presentation is for general educational purposes. It is not legal or tax advice for a particular taxpayer. Charitable planning depends on the taxpayer's complete facts, current law, state law, governing documents, valuation evidence, and the timing and form of the transfer. Opening. A client tells you, I gave $100,000 to charity this year, so I get a $100,000 deduction. Is that statement correct? The honest answer is maybe. We need to know what the client gave. We need to know who received it. We need to know whether the client received anything in return. We need to know whether the client itemizes deductions. We need the client's adjusted gross income. We may need the client's basis in the donated property. We may need a qualified appraisal. We may need Form 8283. We may need a contemporaneous written acknowledgement from the charity. And beginning in 2026, we also need to consider a new floor on itemized charitable deductions and a new limitation on the benefit of itemized deductions for taxpayers in the highest bracket. That is why charitable planning becomes advanced very quickly. But advanced does not have to mean inaccessible. In this video, I'm going to build the subject from the ground up. I'm assuming that you may be an intern, a new tax associate, or someone with an undergraduate background in accounting and taxation who has never worked on a charitable matter. I will define the terminology before using it, and I will show the calculations. I will explain what the rules look like in an actual tax workflow. By the end, you should be able to answer 5 broad questions. First, what is a deductible charitable contribution under Internal Revenue Code Section 170? Second, what can a taxpayer contribute, and how do different types of property change the deduction? Third, how do we value non-cash property and satisfy the substantiation rules? Fourth, how do the adjusted gross income percentage limitations work, including the new 2026 rules? And fifth, how do the major charitable planning vehicles fit together, including donor-advised funds, private foundations, charitable remainder trusts, and charitable lead trusts? We are also going to separate 3 ideas that are often collapsed into one. The first idea is that the economic gift, what actually left the donor's hands. The second idea is the charitable deduction, what amount the Internal Revenue Code may allow. The third idea is the tax benefit, how much federal income tax the deduction actually saves. Those 3 numbers can be different. A donor can transfer property worth $100,000, but receive a deduction of only $20,000 because basis controls. A donor can have a valid $100,000 deduction, but only use part of it this year because an AGI ceiling applies. And a donor can deduct $100,000 without saving $100,000 of tax because a deduction reduces taxable income. It is not dollar for dollar credit. That distinction is foundational. One more orientation point before we begin. Charitable planning is not about wealthy families creating trusts. The subject begins with ordinary gifts, cash, checks, payroll deductions, clothing, stock, volunteer expenses, and IRA distributions. The more sophisticated vehicles are built on the same foundational questions: qualified recipient, completed transfer, valuation, percentage limitation, documentation, and the donor's actual objective. So we are going to start with Section 170 and not with the alphabet soup. Then, once the foundation is in place, CRUT, CRAT, CLAT, DAF, QCD, and private foundation will make much more sense. Let us begin with the most basic question. What is a charitable contribution? Chapter 1. What counts as a charitable contribution? Internal Revenue Code Section 170 is the principal federal income tax provision that allows a deduction for charitable contributions. For an individual who itemizes deductions, the deduction generally appears on Schedule A of Form 1040. Beginning in 2026, a limited deduction is also available to certain taxpayers who take the standard deduction. We will cover that later. At the most basic level, a deductible charitable contribution requires 4 things. There must be a transfer. The transfer must be made with donative intent. The recipient must be a qualified organization. And the donor cannot receive an equivalent benefit in return. Let us unpack those. A transfer means the donor must actually give something away. A pledge is not enough. A promise to contribute next year may be morally binding, but it is generally not deductible until payment is made. Donative intent means the payment is intended as a gift rather than the purchase of something of equal value. A qualified organization is an organization described in the relevant provisions of Section 170C. The most familiar examples are churches, schools, hospitals, and organizations described in Section 501c3. Governmental units can also qualify when the gift is exclusively for public purposes. Certain veterans organizations, fraternal organizations, and nonprofit cemetery companies may qualify under specific rules. And the final requirement is that the donor cannot receive an equivalent benefit in return. This is where the phrase quid pro quo enters the discussion. Quid pro quo simply means this for that. The donor pays money and receives goods or services in return. Suppose the taxpayer pays $500 to attend a charity gala, and the dinner and entertainment are worth $150. The economic payment is $500, but the potential charitable contribution is only the excess of the payment over the fair market value of the benefit received. $500 minus $150 equals a $350 charitable contribution. The entire payment does not become deductible merely because a charity received it. Now, suppose the donor receives a small mug, calendar, or similar low-cost item. Certain insubstantial or token benefits may be disregarded under inflation-adjusted IRS rules, but the general principle remains the same. Determine what the donor gave and what the donor received. This principle also explains why raffle tickets and bingo payments generally are not deductible charitable contributions. The taxpayer is purchasing a chance to win. That is not a pure gift. It also explains the rule for college athletic seating rights. Before 2018, taxpayers could deduct a portion of certain payments for the right to purchase college athletic tickets. Current law disallows a charitable deduction for payments made for the right to purchase tickets or seating at a college athletic event. The label on the payment does not control, the substance controls. A charity can call an event a fundraiser. A taxpayer can describe the check as a donation. But we still ask whether the taxpayer received something of value in return. Now, let us identify several payments that are commonly misunderstood. A gift to an individual is not deductible under Section 170, even if the individual is experiencing hardship. The gift may be generous, it may be socially valuable, but it is not a charitable contribution to a qualified organization. A payment to a political candidate or political organization is not a deductible charitable contribution. A gift to most foreign organizations is not deductible for U.S. federal income tax purposes, subject to narrow statutory and treaty-based exceptions. The value of donated services is not deductible. A lawyer cannot deduct the fair market value of 10 hours of pro bono work. An accountant cannot deduct the hourly billing value of preparing a non-profit's return for free. A volunteer cannot deduct the value of the volunteer's time. However, unreimbursed out-of-pocket expenses incurred while performing charitable services may qualify, and we will return to that distinction. The value of allowing a charity to use property is generally not deductible. If a taxpayer allows a charity to use a vacation home for a week without charge, the taxpayer has generally donated use of the property, not the taxpayer's entire interest in the property. The partial interest rules usually prevent a deduction. Another common mistake is assuming that every Section 501c organization is eligible to receive deductible charitable contributions. Section 501c contains many different categories. The familiar charitable category is Section 501c3. A business league under Section 501c6, for example, is tax exempt, but contributions to it are not automatically deductible as charitable contributions. That's why verifying the organization's status matters. The IRS tax-exempt organization search tool, sometimes referred to in practice through the older Publication 78 terminology, allows a preparer to confirm whether an organization is eligible to receive tax-deductible charitable contributions. For a new tax associate, this is not an academic step. If the client gives you a spreadsheet with 50 organizations, you should not assume that every name on the list qualifies. You verify. You can also check the date. An organization can lose its exempt status. A prior year determination does not necessarily establish current deductibility. Now, let's work a basic client intake example. A client provides the following payments: $10,000 to a local hospital foundation, $2,000 directly to a neighbor whose house burned down, $5,000 to a political campaign, $1,000 to a charity auction where the client received artwork worth $700, and $500 of professional services performed without charge for a qualified charity. The hospital gift may qualify, assuming the organization is eligible and the client has the proper substantiation. The direct gift to the neighbor is not deductible under Section 170. The campaign contribution is not deductible. The charity auction payment produces a potential contribution of $300, which is the $1,000 payment minus the $700 value received. And the $500 value assigned to donated services is not deductible. This is the first discipline of charitable tax work. Classify the payment before calculating the deduction. Do not begin with the client's total. Begin with the transaction. Chapter 2. When is the gift made and what documentation is required? Timing and substantiation are two of the most practical parts of charitable contribution work because a technically valid gift can lose its deduction through poor execution. First is timing. A charitable contribution is generally deductible in the year the gift is delivered or completed. For a check, the contribution is generally treated as made when the properly addressed and stamped check is mailed, even if the charity deposits it in the next year. For a credit card contribution, the gift is generally made when the charge occurs, even if the taxpayer pays the credit card bill in a later year. For an electronic transfer of publicly traded stock, the contribution generally is complete when the shares are transferred into the charity's account. For a physical stock certificate, the transfer rules depend on proper endorsement and delivery, and a pledge is not deductible until the donor actually pays it. This becomes important at year end. A client may tell you, "I donated stock on December 31st. But the brokerage statement may show that the shares did not arrive into the charity's account until January 3rd. The client's intention does not determine the tax year. Completion of the transfer does. Now, let us move to substantiation. The substantiation rules are strict enough that they should be treated as part of the transaction itself, not as paperwork to clean up after the return is prepared. For a cash contribution of any amount, the donor generally must retain either a bank record or a written communication from the charity showing the charity's name, the date, and the amount. That means the old idea of dropping anonymous cash into a collection plate and estimating the annual total is not enough without a qualifying record. For any contribution of $250 or more, whether cash or property, the donor must obtain a contemporaneous written acknowledgment from the charity. That phrase matters, contemporaneous written acknowledgement, often abbreviated CWA. The acknowledgement generally must state the amount of cash contributed, describe any non-cash property contributed, and say whether the charity provided goods or services in exchange. If goods or services were provided, the acknowledgement generally must include a description and a good faith estimate of their value, unless a specific exception applies. Contemporaneous generally means the donor obtains the acknowledgement by the earlier of the date the tax return is filed or the due date of the return, including extensions. A bank statement proves that the money left the donor's account. It does not necessarily satisfy the separate acknowledgments requirement for a contribution of $250 or more. And a canceled check does not tell us whether the charity provided goods or services in return. This is why the acknowledgement is so important. The charity does not file the acknowledgement with the donor's tax return in the ordinary case. The donor retains it. But if the IRS examines a deduction, the acknowledgement can determine whether the deduction survives. The basic lesson is simple. For a contribution of $249, a bank record or qualifying written communication may satisfy the cash substantiation rule. For a contribution of $250, the contemporaneous written acknowledgement requirement applies. That $1 difference changes the documentation. For payroll deductions, the taxpayer generally uses a pay stub, Form W-2, or another employer-provided document showing the amount withheld, together with the pledge card or similar document identifying the charity. Each payroll deduction is generally treated as a separate contribution for the purposes of the $250 acknowledgement threshold. Now, let us add non-cash property. If the total claimed deduction for non-cash contributions exceeds $500, the taxpayer generally must attach Form 8283, non-cash charitable contributions, to the return. For property over $500 but not over $5,000, the taxpayer generally completes Section A. For property over $5,000, a qualified appraisal is generally required, and the taxpayer generally completes Section B of Form 8283. Publicly traded securities are a major exception to the appraisal requirement. For non-cash contributions exceeding $500,000, the taxpayer generally must attach the qualified appraisal itself to the return. There are additional specialized rules for vehicles. For a donated car, boat, or airplane with a claimed value of over $500, Form 1098-C or a qualifying equivalent acknowledgement must generally be attached to the return. Think about the escalation pattern. Cash gift, any amount, bank record, or written communication. Contribution of $250 or more, contemporaneous written acknowledgement. Non-cash deduction over $500, Form 8283. Most non-cash property over $5,000, qualified appraisal, and Section B. Non-cash property over $500,000, attach the appraisal. Vehicle over $500, Form 1098-C or equivalent. A new associate should create documentation tracker before preparing the return. For each gift, list the date, recipient, cash or property, amount or claimed value, donor's basis if relevant, acknowledgement received, Form 8283 requirement, appraisal requirement, and any special form. Do not wait until a review to discover that the client donated cryptocurrency worth $80,000 but never obtained an appraisal. Let's work an example. A client donated the following during the year: $100 in cash to a church supported by a bank statement, $1,000 by check to a hospital supported by canceled check but no acknowledgement, $4,000 of publicly traded stock, $7,000 of privately held stock, and a used car that the charity sold for $3,000. That $100 cash gift may satisfy the record requirement if the bank record identifies the transaction adequately. The $1,000 hospital gift requires a contemporaneous written acknowledgement because it is at least $250. The canceled check alone is not enough. The publicly traded stock generally requires Form 8283 because the non-cash deduction exceeds $500, but publicly traded securities are generally exempt from the qualified appraisal requirements. The privately held stock requires a qualified appraisal in Section B because the claimed value exceeds $5,000. The vehicle deduction generally depends on the charity's gross sale proceeds and requires Form 1098-C or an equivalent acknowledgment. Notice what the preparer is doing. We are not merely adding 5 amounts. We are assigning a documentation regime to each transaction. That is what makes substantiation a technical tax issue rather than clerical housekeeping. Chapter 3: Cash, Property, Basis, and the appreciated stock strategy. Now we turn to the property itself. Cash is straightforward. A dollar of cash is generally worth $1, subject to the percentage limitations and documentation rules. Property is more complicated because the fair market value and tax basis may be different. Basis is generally the taxpayer's investment in the property for tax purposes. If a taxpayer buys stock for $10,000, the starting basis is generally $10,000. If the stock later becomes worth $50,000, the taxpayer has $40,000 of built-in appreciation. The charitable deduction may depend on what kind of income the taxpayer would recognize if the property were sold. That is the logic behind Section 170E. If the donated property would produce ordinary income or short-term capital gain on a sale, the charitable deduction is generally reduced by the amount that would not have been long-term capital gain. In many ordinary situations, that means the deduction is limited to basis. Examples include inventory, stock held for 1 year or less, and artwork created by the donor. If an artist donates a painting the artist created, and the artist generally does not deduct the painting's retail gallery value, the deduction is generally limited by basis, which may consist of the cost of the canvas, paint, and other materials. By contrast, long-term capital gain property donated to a public charity may generally be deducted at fair market value, subject to the applicable percentage limitation. That is what makes appreciated stock so powerful. Assume Maria owns publicly traded stock worth $50,000. She purchased it years ago for $10,000. The stock contains $40,000 of long-term appreciation. Maria wants the charity to receive the economic value of the investment. Option 1. Maria sells the stock and donates the cash. Assume, only for illustration, a combined federal long-term capital gains and net investment income tax rate of 23.8%. Tax on the $40,000 gain would be $9,520. After paying that federal tax, Maria would have $40,480 available to contribute. Option 2. Maria contributes the stock directly to the public charity. The charity, assuming it is tax exempt and the sale is not part of an unrelated taxable activity, can generally sell the stock without paying the capital gains tax Maria would have paid. The charity receives the full $50,000 of value. Maria may receive a $50,000 charitable deduction subject to the applicable AGI limitation and the other rules. The direct stock gift can therefore provide 2 economic benefits. First, more value reaches the charity. Second, Maria may receive a larger charitable deduction. This is why an appreciated asset review should be routine in charitable planning. Before a client writes a large check, ask whether the client holds long-term appreciated publicly traded securities that the client was already considering selling. The critical sequence is contribute first, sell second. If Maria sells the stock and then gives the cash, the gain has already been realized. The charitable contribution does not reverse the sale. And if a sale is already legally binding before the contribution, the assignment of income doctrine may create additional issues. The timing and transaction documents matter. There's also a practical portfolio benefit. A donor can use charitable giving to remove a concentrated appreciated position without personally recognizing the embedded gain on the donated shares. The donor may then use other cash that would have been donated to rebalance the portfolio. This is sometimes described as charitable rebalancing. But not every appreciated property gift receives a fair market value deduction. We need to know the recipient. Long-term capital gain property given to a public charity generally receives the more favorable treatment than the same property given to a private non-operating foundation. We also need to know the kind of property and how the charity will use it. That brings us to tangible property. Tangible personal property means physical, movable property, artwork, jewelry, furniture, collectibles, equipment, and similar items. The related use rule asks whether the charity's use of the property relates to the charity's exempt purpose. Suppose a donor gives a painting to an art museum, and the art museum displays it as part of its collection. That is a related use. A fair market value deduction may be available subject to other requirements. Now, suppose the donor gives the same painting to a medical charity, and the medical charity immediately sells it to raise cash. The use of the painting itself is not related to medical charity exempt purpose. The deduction may be reduced to basis. This rule prevents a donor from receiving a full fair market value deduction for property whose special value is unrelated to the charity's work. There is also a recapture rule wherein the donator claimed a fair market value deduction for certain related use property over $5,000 and the charity disposes of it within 3 years. Unless the charity makes the required certification, the donor may have to include the prior deduction excess over basis and income. The charity reports certain dispositions on Form 8282. Now, consider property that declined in value. Suppose a donor bought stock for $50,000 and it's now worth $30,000. If the donor contributes a stock, the charitable deduction generally cannot exceed the $30,000 fair market value. The built-in capital loss disappears. The donor generally does not get both a charitable deduction and a capital loss for the same decline. A more efficient sequence may be to sell the lost property, recognize the capital loss, and donate the cash proceeds. So the familiar rule of thumb is donate appreciated property, sell depreciated property, and donate cash. That is a planning heuristic, not substitute for reviewing the complete facts, but it's a strong starting point. Let's compare 4 assets. Asset 1 is publicly traded stock held 3 years worth $100,000, basis $20,000. Asset 2 is publicly traded stock held 6 months worth $100,000, basis $80,000. Asset 3 is inventory worth $100,000, basis $60,000. Asset 4 is stock worth $60,000, basis $100,000. For asset 1, a direct gift to a public charity may support a fair market value deduction and avoid recognition of the built-in long-term gain. For asset 2, the short holding period generally causes the deduction to be reduced, often to basis. For asset 3, the ordinary income property rule generally limits the deduction to basis unless a specific enhanced deduction provision applies. For asset 4, the donor should examine whether selling first would preserve the capital loss before contributing cash. The asset's economic value is only the first number. The tax character determines the deduction.